In this week's video, we'll review the latest charts to help us answer the question, what does history say about the stock market's V-shaped bottom? If I showed these charts to you with the labels removed and you were well versed in the markets and in technical analysis, you would be hard-pressed to say that they really look discernibly different. At a minimum, you would say they share similar characteristics. We'll cover these charts during the video, but in one case, a crushing decline is only weeks away. In another one of these three cases, eye-popping gains occur over the next 2 years. And the third case, and they're not in any particular order here, is January 10th, 2019. Telling us that it's pretty fair to say what happens for the remainder of 2019 and what happens over the next few days, few weeks, and few months definitely falls into the to be determined category. This is a daily chart of the S&P 500 index as of the close on Thursday, January 10th, 2019. We're using generic and for illustrative purposes only daily moving averages from the 50-day simple moving average in blue all the way out to the 200-day moving average in orange. What we'll be covering here is somewhat of a remain cool, calm, and collected playbook. The charts that follow will help us understand context today, and more importantly, they will help us understand context moving forward. Everybody has to understand what works best for them. For us, we like to have hard data, numbers that we can reference, and we also like visual references. Sometimes the difference between executing properly and improperly is a visual reference or understanding context. So what we'll be comparing here in bullish and bearish cases, this is a somewhat unusual plunge here. We're 11 trading days off of the low. As we've covered in recent weeks, the cases on the screen have similar characteristics to the present day from many different perspectives. So in every case here, this is 11 trading days after a plunge low, 11 trading days after a plunge low, 11 trading days after a plunge low, and 11 trading days after a plunge low. And when we flip over to the bearish examples, it becomes much, much easier to understand why discipline and executing relative to the data that's in front of us is so important. The cases that are on the screen and the periods on the screen also have similar characteristics to what was present in late 2018, early 2019. From a discipline perspective, if we glance at this chart and glance at this chart, it's very, very difficult to say the trends are discernibly different, telling us that if we're making assumptions in the present day, that could come back to burn us a few weeks or a few months down the road. Since these charts will actually become more useful to us as price moves either in this direction or in this direction, we'll move relatively quickly, making a few simple observations along the way. This playbook will allow us to understand what a bullish case looks like walking forward, and in the other examples, what bearish cases look like walking forward. And as price walks forward in the present day, we can discern between the binary cases. Higher highs come here, and in the bearish cases, lower lows follow. One of the first things that jumps off the page here, that in every single case that ultimately has a long-term favorable outcome, the original plunge low was retested in some way. Several weeks later, it's retested. Several weeks later, it's retested. Several weeks later, it's retested and actually exceeded with a lower low. And in this case, this is our initial plunge low. This is somewhat of a V bottom, similar to what we have in the present day. Eventually, it was retested and a lower low was made. As we've mentioned in the past, a retest can take many forms. A retest can be coming back and making a higher low. It can be coming back and making a lower low, or it can be coming back to basically the same area and holding. As you can see, thus far in the present day, we really don't have anything that looks like this, 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 or this. And that's all to be determined. And for comparison purposes, on the bearish side of the ledger, here is your V bottom look here. We get a plunge, a rapid rally with no significant retest or retracing of any kind, and eventually this rally fails in a spectacular fashion. In this case, you can make an argument that we do come back and retest this low, but in this case, the retest fails and price plummets in this direction. But it does contain a retest because we know retests can pass or they can fail. So in the present day, that might happen. We may come back and retest the low. It may or may not hold. That's why we call it a test. In the 2008 case, here's your plunge low. We rally off the plunge low, and we eventually retest that low via a lower low, and even that low is retested again. Same thing in the 2015 case. Here's your plunge low. We walk forward. Eventually, it's retested. We rally, and this rally fails. Obviously, if you're watching this video, you can study these charts on your own. A few quick things that jump off the page in the cases that are eventually followed by much lower lows. In the V-bottom case, we rally back to a downward sloping 200-day moving average and try to clear the 200-day 1, 2, at least 3 times and fail. And notice on the third failure here, it's a downward sloping 200-day. A flattish 200-day or a 200-day that was turning up would give us a higher probability of succeeding. In this case, we fail at the 75-day, and in this case, we obviously have a well-established and strong negative trend, downtrend here. The 2008 case, this is a strong rally that we covered last week. We come to a downward sloping 200-day moving average and fail miserably. The 2015 case is a little bit different, but notice the 200-day almost works like a magnet. Price can't move away from it in a convincing fashion. It tries to do it 1, 2, 3, 4 times, and we get a failure. You can also see in these cases, price has a tendency to also drop back below the moving averages 1, 2, 3, 4 times. 1 time here, 1, 2, 3 times, and a failure. In the present day, we haven't tested any of these moving averages. And it's very, very difficult to say that the market has proven much of anything from a trend perspective at this point. It may, but it hasn't yet. Back to the cases where eventually the low is followed by higher highs. Emphasizing again, not one of them is a V bottom. And remember, in the negative lower lows to come cases, downward sloping 200-day, we fail. Downward sloping 200-day, we fail. Flattish to downward sloping 200-day, several attempts to try to clear it, and we fail. Compare and contrast that with these cases. 1987 case, the first attempt at the 200-day is successful, we hold it. First major attempt at the 200-day here, upward sloping 200-day, telling us the probability of recapturing it is higher, successful. In this case, we get 1 failure, somewhat of another retest or backtrack of this low. And then when we get back to a flattish 200-day, we really run away from it in a convincing and bullish manner. We see nothing like this in the negative lower low cases. Same thing in 2016 when the low finally holds, unlike the low in 2015. Price comes back almost in a straight line off of the retest low and then retakes the 200-day moving average relatively easily. So in 3 of the 4 cases here, the first attempt at the 200-day moving average is successful. Price holds above it. Price holds above it with white space. Price holds above it with white space for the most part above the 200-day, which is turning back up. Once it clears it, it really never looks back in this case. That's significantly different from this downward sloping, price really can't get above. Downward sloping, price can't even poke its head above for a short period of time. And here, flat starts to roll over. Here are some examples of what once acted as support may now act as resistance. 1987 case is a little bit different because we have this gigantic gap down. So this gap, the top of the gap, would act naturally as resistance. And what once acted as support here may now act as resistance. The 2011 case is more like the present day. What once acted as support, may now act as resistance in this general area. You can see we have 2 boxes here. Price holds here, price holds here, and price holds here. The first attempt at the second box fails, but then when we really start moving, we blow right through both levels. This is a positive look here. Very, very similar situation here from a positive perspective. What once acted as support in all of these areas may now act as resistance. It fails on the first attempt. After the retest, it sticks to it like glue here in a tight range. That can be a good sign. You're moving in this direction, you consolidate and move. You're moving in this direction, you consolidate and move. Point of the exercise, the bottom of the box can act as resistance, and once you break through it, it speaks to probabilities, especially in a convincing manner, The 2015 failure and 2016 successful low is difficult, which means sometimes simplifying is the right thing to do. Here's the highest high. We can draw a simple trend line here. Once we establish this, you'll notice when we fail in 2011, we never clear it. That's different on the successful attempt. We get above it, below it, above it, below it. Notice on the second attempt, the successful attempt, what once acted as support may now act as resistance. We blow right through that, like it's not even there. The second level, what once acted as support may now act as resistance. We blow through it, and it starts to act, for the most part, as support. So this is a good look here. It's similar to this look here, where we just blow through. So how can that possibly help us in the present day? The present day, we could rally all the way back to 2,700, and we would really just be getting back to this level here. So we would learn something either way here. Obviously, if price can blow through this and move in this direction, that's a positive, especially if we can clear these levels here. Here's one positive. The first line of defense on a high-low close chart, we did pretty much just blow through that. But then at the close on Thursday, January 10th, we did stop at this, what once acted as support, may now act as resistance. If we blow right through that one, that's another positive sign telling us to keep an open mind about all outcomes. It doesn't look as good in the present day if we look at closing prices. Here's our bottom box. What once acted as support in these three areas may now act as resistance. We really haven't cleared this in a convincing manner yet, and then we still have the second line of defense above in the second box. You can also draw a trend line. This is a higher high. This is a lower high here and here. We have no idea whether any of this will act as resistance or not. It just helps us with probabilities. If we blow through all of them, that's bullish. So once again, the purpose here is not to predict what's going to happen. We simply have reference points. The historical charts really don't have anything to do with how we execute. They just help us execute better. They help us remain patient and understand that a chart like this in the present day, as of Thursday's close, really doesn't look appreciably different than this point in here off of this low. It's possible the market's going to blow through all of these moving averages. It's possible they will act as resistance. We'll learn something either way. If you watch these videos regularly, you know that we never arbitrarily pick historical cases. We always pick historical cases that share something very specific with the present day. On Twitter, Tony Dwyer noted, there have only been 3 prior 20% plus plunges in the S&P 500 in a non-recessionary environment. 1987, 1998, 2011, and 2018-2019 is the 4th. Tony points out that the probability of a low holding, and notice we're saying probability, which is far from the term certainty, increases when 2 things happen. Number 1, when the 10-week rate of change on the S&P 500 moves from below -9, in this case it's at -30, and then it moves back to above -5. It occurs here, and at this point in 1987, the low is in. Doesn't mean life is easy from here. It just speaks to odds of moving higher. The second signal is tied to the VIX. Since there is no VIX in 1987, we'll skip that. The second of 3 historical plunge cases in a non-recessionary environment, 10-week rate of change for the S&P 500 moves to below -9, and then it rallies back to above -5. When this occurs, the low is in, and that includes the retest in this case. Notice, the low is made between August and October. The low is made between August and October. The second piece of the probability puzzle, we want the 10-week rate of change for the VIX to drop from above 80 to below 10%. That happens here in early to mid-October, which is where the low is in the S&P 500, and this low does hold. And the cases are very, very similar here. We get the 10-week rate of change. We can check that box. 2011, near the low. Also notice we go back above -5 at the retest, and then we hold above -5 after the successful retest. And that retest occurs in the S&P 500 in early October. And in early October, we get the second piece of it. The VIX falls from above 80%, the 10-week rate of change, back below this line here. We've covered the 2008 case in the past. For numerous reasons, it's similar to the present day. However, it cannot check both of these boxes. It can check the 10-week rate of change box. We move back above -5, near the low, the intermediate term low that occurs in March of 2008. But near that low, we can't check the second VIX box. Something similar happens. We move from 43% back below. So it's similar, but only checks one of the 2 boxes. There's also a low in the S&P 500 that occurs in November of 2008. In this case, we can check the 10-week rate of change box. It moves from below -9 back to above -5. And remember, before we go to the VIX, the intermediate term low during the bear market occurred in November of 2008. And in early December of 2008, we can check the second box for the VIX. 10-week rate of change moves from above 80 back to 10. There's a 3-week rally off of a low in 2001. It can only check one of the two boxes. It can check the S&P box. Remember, the low comes early in 2001. We get a similar setup with the VIX, but it only moves from 63. In this case, we can check two boxes. This is your V bottom low that occurs within the context of a bear market. There is no retest. The 10-week rate of change for the S&P 500 moves from below 9 back to above -5 here. The point of showing the bear market cases is we can get the 10-week rate of change and the VIX signal within the context of a bear market. The low comes in September, October. After that, we get the signal here above 80, back to 10. Can check both boxes. 2015, 2016 shows us that sometimes this is a tradable signal. 10-week rate of change in 2015 near the low in the S&P 500 moves from below -9 back above -5 near the low. Helpful. The problem is this move is fully retraced. And then at the low that actually holds, we get the signal again. S&P 500 10-week rate of change falls below -9 and eventually rallies back to 5, and this low does hold. And in this case, our low in 2015 comes September, October. The low in 2016 in February. For the VIX, we check the boxes, both of them. The low in the S&P comes here. We move back to our line, check the box. We're above 80 at the major low that holds. Here, the market bottoms almost simultaneously with checking the VIX box. Where do our rate of change signals stand on Friday, January 11th at 1:45 p.m. Eastern Time? Somewhat mixed. We're hovering right around -5 intraday, -4.88. So this is a good move, but I really wouldn't say it's a convincing move, because if you look at the lows and the convincing lows that were made, your rate of change, we'd really like to see it move in this direction and recapture 0. So a mixed bag here tells us to be open to a V bottom and or a bottoming process. You can see on this weekly chart too, what once acted as support may now act as resistance. What once acted as support may now act as resistance. Even the weekly chart intraday is running into a logical area of resistance. All resistance is possible resistance, open to all outcomes, from a move this way to a sharp move in this direction. Probably a better look on our rate of change for the VIX. We were above 80 in the present day, and now we're well below the 10 line here. Again, telling us to keep an open mind about a V bottom and or a bottoming process. We're all human, so it's very, very easy in the present day to feel somewhat panicked and out of control here and feel that we're missing something. Let's put some context around these cases here. If you were patient 11 trading days after the low in 1987, how significant was that for an investor? The gain from this point here, meaning you didn't even have to catch the low, to this point B here several years down the road was over 500%. And typically, the way lows are formed is after the plunge low, you get some type of consolidation and confusion that typically involves one or more retests of the original low. Feels like you're missing a lot in here from a human perspective. More often than not, during this period here, the data slowly improves in an incremental manner. You can see the data here looks quite a bit different than the data here, here, and here, telling us in many of the bullish instances, while it feels unsettling here, typically the market gives you plenty of time to scale back in as the data improves. This area here is this area here, and after that, good things happen for a long period of time. How about the 2011 case? If you had cash and had a relatively conservative portfolio 11 trading days after the plunge low, what did that mean relative to an investor's time frame? From this point here, meaning you didn't even wait for the retest here, the S&P 500 gained 83% over the next several years. If good things are going to happen, typically after a plunge, the data has some time to improve. You can see that visually here. This is typically what a more sustainable bottom or base looks like. This is where the market really starts to run. The hard data here looks infinitely better than the hard data in here. And this period here is this period here, telling us if we take a step back, it's much, much easier to be patient and execute properly in January of 2019. There's another reason to be patient. We don't know if 2019 is going to resolve itself in a bullish manner or a bearish manner. What happened in the V-bottom case if you jumped the gun, threw all caution to the wind, and went all in? In this case, after the V-bottom with no discernible base down here, really, really bad things happened. We're already in a bear market here. The additional loss after the rally from the high to the low was almost 35%. So the moral of the story here is very, very similar to the moral of the story last week. If we front run the data here and throw all caution to the wind, we're going to be over allocated here and not properly set up to deal with what was an additional loss in this case of almost 53%. As this move from here to here shows, and this move from here to here shows, we can get big counter trend rallies within the context of a bear market and or an existing downtrend, and really, really bad things can continue to happen after counter trend moves, as we've covered in recent weeks. We can only mitigate the losses in these cases if we stay aligned with the data. How about the 1988 case? If you were sitting on cash 11 trading days after the low, what did that mean relative to the big picture? The gain from this point here, and that assumes you didn't even wait for a retest, was 50% from point A to point B. Typically, not always, we get a rally, a retest of the low in some shape, form, or fashion, and some consolidation that helps us form a base of some kind to allow for a sustainable rally. You can see in this case, using our for illustrative purposes only generic moving averages, the data improves. You can see it improving here. We don't need to jump the gun. And unlike the V-bottom that we have currently in the present day, This is typically what a more sustainable basing process looks like. We may very well have a V-bottom in the present day. We'll continue to take it day by day and be driven by the data, not historical charts. How about the 2016 case? How much did you miss if you hadn't done much 11 trading days after the low and you were still respecting the concerning profile and hard data that you had in hand on February 4th, 2016? Phrase it another way. What happened next? From this point A here, where we don't even wait for the retest of the low and the lower low, if we round up, the gain from point A to point B was 50%. And we can clearly see how the data and the trends improve here using our generic and for illustrative purposes only moving averages, allowing us to visualize how it's possible to be patient and scale back in and get fully invested in time to participate in what could be extremely satisfying gains over a long period of time. Here are the exact same moving averages on Friday, January 11th at 11:43 a.m. We're still below downward sloping moving averages in every case. Hard to make an argument that this looks discernibly different from this or this. And while we know that you can get big, huge, sharp, oversold counter-trend rallies, given the fact that we mentioned it way back on December 20th, under our approach and to properly manage risk and to be ready to handle all outcomes, it's imperative that we stay aligned with the data. The trend strength portion of the model, which is one of many inputs in the model, down at the low is at 0. We're properly allocated here. We ran the model during Friday's session. Despite this improvement here, the trend strength model still at 0. And you can see from this low here to this point here, is there any appreciable, noticeable, and discernible change in the look of these moving averages? The answer is no. That could change quickly if we move in this direction. And the historical examples show how that can happen. And if it does happen, we are more than happy to start scaling in at a much faster rate. So a fair question might be, last week you said that the stock market was flashing bottoming signals. And you added last week to the growth side of the portfolio. A fair question might be, why was the add so small? Because we have to stay in line with the data. Heading into this week, we were at maximum allowable exposure on the equity side. When the data improves, we can start scaling in at a faster rate if price moves in this direction. But we can't assume that. We'll continue to take it day by day at a measured and data-dependent pace. And we have no idea in the present day if we're going to follow the typical script and retest the low in some shape, form, or fashion. But we know in every one of the similar historical cases that produce sustainable higher highs, a retest of the low occurred. And we also know from short takes that the give back from the oversold rally high to the retest low can be significant, on the order of 14% in the 1987 case, 13.39% give back on the retest in the 1998 case, and a 12.67% give back in the 2011 case. Not meant to predict anything about what's going to happen in the present day. It's just good to understand how sustainable market turns typically take place. It's very, very easy as human beings when the market moves off of this low and moves for several weeks in a bullish manner to have a very short-term focus, to start making decisions based on green screens and emotions or the fear of missing out. It gets very, very easy to start watching the market too closely, tick by tick, hour by hour. The closer we get to the market, the easier it is to forget the bigger picture. If you traded the markets in 2008, you know that this felt like you were missing out if you had cash and bonds in your portfolio. Were you really missing out? And was it smart to ignore the data and throw all caution to the wind? In this case, the answer was a definitive no, when the market reversed and produced an additional loss of over 50%. We know that all bullish trends have 100% normal and to be expected counter trend moves. We also know that all bearish trends have 100% to be expected and normal counter trend moves that can be very sharp within the context of a bear market. We're not saying we're in an ongoing bear market, but we unquestionably have bear market type statistics in front of us on January 11th. That may change soon, but it hasn't changed yet. And despite these 100% normal and to be expected counter trend moves that can occur within the context of a primary downtrend, the facts are that every single one of these counter trend moves was retraced entirely, and the market went on to make lower lows. So the moral of the story for us: maximum flexibility. Be open to all cases from wildly bullish to wildly bearish. Take it day by day. No front running and guessing on the data, and no forecasting. If really good things are going to happen, the data not only will improve, it has to improve. It's just the way the math and trends work. And if really, really bad things are going to happen again, and this is a counter trend move, then we will see failures at logical levels, and the slopes of our moving averages will be down and remain down. So as we head into next week, we will do what we've done over the past few weeks. We will take a patient, prudent, measured, and data-dependent approach. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.